Ladies and gentlemen, I think that there's a massive disparity between what Wall Street thinks about SoFi's total addressable market and what management and myself also think on the other side. Now, this all started from Giuliano Bologna, who ended up putting out this article. It's actually from Compass Point, but he runs their research group that covers SoFi. Anyway, they actually believe that SoFi is suffering from their own success. And although they believe that originations is going to continue to climb all the way through to the end of 2026, they also think that there's a certain barrier once SoFi passes this 15% total market size that every company that's done this in the lending space has suffered in whatever area that they are taking 15% more of total market share. Okay. But then whenever you get into their credit box, this 721 FICO score plus, they are actually nearly getting into the 30% ranges, which is far beyond what Compass Point thinks that they can hold up. And this is still very early on, let alone what is going to happen all the way through 2026. Now, already we have some disparities, right? Because this was the number that they gave away in Q3 of 2024. They were expecting SoFi's Q4 of 2024 to come in just slightly lower, these two bars here. So this one was going to be slightly lower, which they also anticipate was going to continue to ramp into 2026. But as you can see from SoFi, it never did lower. So the two bars represented here, Q3 to Q4, actually increased even more. So SoFi did even more originations than they were expecting. A total of $17.6 billion in annual personal loan origination volume, which was just massive and way higher than what Compass Point thought that they were going to do. But this doesn't take away from the fact that SoFi is still eating up that market share faster than potentially they should be. Right now, in the TransUnion data, which is the same data that Giuliano used here, the TransUnion data, they say about the personal loan market is about $155 billion in a total market share. Okay, this is annualized loan originations. Okay, yet Anthony Noto believes something different. This happened in the B of A conference that just happened back in February, okay? He said, I think one of the biggest misperceptions is that when people calculate our market share in personal loans, in the numerator, they put our originations. And in the denominator, they put our prime US personal loan market. That is not the market. Okay, so that would assign essentially a 11.35% market share, which is exactly what Giuliano Bologna did, right? So he's exactly calling them out here. However, just like Lending Club, they are not highlighting the total size of personal loans. They're highlighting the total size of revolving consumer credit, okay, which is currently standing at $1.36 trillion, okay? Now, let's finish out this quote from Anthony Noto. The market is credit cards, prime credit cards, which is over $1 trillion. And the reason why it's credit cards is two reasons. One, we have about 80 to 90% of our personal loans are already currently consolidating credit card debt, which would place them, by the way, at a 1.29% of total market share, not 11.3%. And this makes a lot of sense. If you look at the product that SoFi is actually highlighting here, what they're trying to do is replace or have a better tool to do debt consolidation. So previous personal loan products never fit this mark because of the, 3 to 7 day funding, the origination fees, prepay penalty fees. These things made it very hard to sort of replace credit cards on a revolving basis. Now, SoFi immediately tries to highlight that whenever you apply for a SoFi personal loan, one, you're going to get much lower rates than what you had from credit cards. There's going to be no prepayment penalty fees, and you do not have to take on origination fees if you want to pay a higher interest rate, but still 10 points lower than what you'd pay on your credit card. And it's same day funding. So you can immediately assess those problems. And they go even further because they know 80 to 90% of the people that are coming for a personal loan are doing it to debt consolidate. They have tools like direct pay. We'll pay your credit card lender for you. Okay. You don't even need to take the money into your personal account and then go outlay it. We will do it for you. Okay. And they obviously have massive awards because of the types of fees, the ease of signing up, the low fees. But let's continue. But the personal loans that we're extending to them are interest and amortization of the principal. Think about the credit card business. The best credit card consumers, not SoFi, but industry wide, are revolving consumers. And most revolving customers are drawing down, let's say, $5,000 to $10,000 in credit card lines. That $5,000 is not being paid down. They will pay minimum monthly payments. It's almost like subscription debt, right? And that's exactly true. All these people are doing is going ahead, racking up a lot of credit card interest. This is why you're seeing, reports coming out even today saying that the credit card balances are at an all-time high, and that people are just simply running up a certain amount and paying off the minimum fees and having essentially what Noto said, subscription debt, where the actual principal never gets paid down. They have no intention of paying this down at the $5,000. Now, he said there's a large portion of those people that are not taking out a personal loan to lower their interest rates, even though they're paying 25 to 30%. They could probably get a loan with us for about 13%. They're not taking out that loan because we amortize down the principal, and that may result in a payment that's equal to what they're already paying just in interest only. There's a world in which we offer a personal loan that's interest only for 5 to 10 years, but at an interest rate that's half of what they're currently paying. Okay. So if you're paying anywhere between 25 to 30%, and SoFi can lower that down to 13%, but still offer those same principles that what you were doing before, which is only paying interest essentially, then they can lower those total amounts of payments. Okay. So you essentially have to outlay about half of what you're used to. The savings, then you could actually go and pay down the principal if you wanted to. It would be in your control because there's no prepayment penalty, similarly to a credit card. They could also invest that money at a good return, and they could use it for other needs. So I believe, just like Anthony Noto believes here, is that this is going to become a no-brainer as they start to pull out new products like interest-only personal loans for a certain period of time. But that brings me back to this page, okay? Everything that we're talking about is sort of talking about this total market share, okay? But really, SoFi is only going after loans that are 720 FICO plus, which means that it's still a much smaller market than what potentially the total credit card market is actually looking at. But this is where we go back to this chart and actually show you guys what the loan platform business is doing. Okay. Roughly about $2.1 billion of the last just 2 quarters. Remember, this new product, the loan platform business, started 2 quarters ago. This is SoFi going out and writing loans for other institutions. Okay. And one thing that Anthony Noto highlights, the loan platform is a way for us to allow our company to serve members outside of our credit box and to serve more members in our credit box if we wanted to go after that volume on our own balance sheet. We don't need to. We're doing that through the loan platform business. Just to clarify, SoFi's balance sheet will only be used for our credit box. We're not changing that credit box. The loan platform business is 100% dependent on what those institutions want. So if they want 650 to 800 FICO score, we can underwrite that. If they want 600 to 800, we can also do that as well. It really comes down to what they want. So we have no intention of putting that on our balance sheet. So going back, this does go over, the total consumer credit lines that could potentially go as low as 600 FICO score, not just looking at whatever the, total amount is of 720 plus. SoFi's market share really is only 1.29% of what they could potentially be growing into. And as you can see, the total addressable market, if you were to have looked at it back here, would have been not as much as it is today. So the market is also growing just as much as SoFi is growing. They just happen to be growing faster than what the market is currently, growing at. But this is only one facet of their business, okay? So even whenever you go and look at the other loan platform businesses, they can't offer them financial services products or home loans or student loans. And so this is only one facet for some reason that some companies on Wall Street are bringing down the stock prices on these companies to $6 or $8 a share based on the total addressable market saturation of SoFi's success is why they could potentially be bringing them down whenever that part is not even true either. Financial services is a massive industry, and SoFi is a very, very small cog in that wheel. However, they are growing quickly, and that's where the money is to be made. Betting on companies where the growth exceeds their expectations. SoFi can have viciously bad days in the market, but that is not an indicator of their success. In fact, it's actually probably one of the worst, and yet it's the one that people pay most attention to. For me, days like today are ways for me to increase my total share of this company while benefiting off of all of these great growth trajectories, like the loan platform business, that potentially are just misunderstood from Wall Street.